Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. We're certainly glad that everyone could join us this week. We know it's been a crazy week. That market volatility has continued. But the good news is that those lows from the week prior have continued to hold. We expected a big short cover rally to establish that low. We got that Friday, Monday, Tuesday. Over the last 2 days, growth stocks in particular have started that retest. And we think that probably Thursday, which is when we're recording this video, was probably the deepest part of that retest. And we expect the path forward to become a lot easier. We think now we're going to get into the more violent upside part of this recovery, where you certainly don't want to be short stocks, and you're going to see more short covering and fundamental long only buying come into a lot of the names that have been, in our opinion, inappropriately beaten down over the last 3 to 4 weeks. So, that gets us into our presentation and the title of this week's presentation, which is the recipe for a violent rally. And what do we mean by that? When we look at overall investor positioning, investment sentiment, and relative performance of stocks, all of that is the most bearish since March of 2020. And what do we in particular mean by that? Retail investors have raised cash at the fastest pace since the pandemic. Stocks are most oversold since March of 2020, those plumb lows of March of 2020 when things were just dramatically oversold. And then lastly, investor sentiment is now at the most bearish since 2013. So when you put positioning, price, and sentiment together and they're all bearish, the level of confidence increases quite dramatically that forward returns can be pretty attractive. In fact, when we look at retail investors right now, 40% of trading volume has become bearish. And that's almost unheard of in the month of January. Now, in terms of those existing market conditions, there's a few things that we always look for. One is, can we invest during periods of high volatility? That can churn our stomachs because the day-to-day can go from being ecstatic to just downright depressed. But high volatility is a function that provides an asset for future returns. What do we mean by that? When volatility is high, uncertainty is high, and asset prices are depressed. As volatility comes down, it's like a lever. It pushes asset prices higher. More certainty, higher asset prices. So we want to invest in periods where volatility is high, not when it's low. And right now, it's certainly very high, and we're going to go through those charts in a bit. We also see oversold conditions across the board. So when we're looking at stock prices and we look back the last 14, the 28, the 36, and 50 days and beyond, the price action in terms of where prices are today versus where they were 14 to 28 days ago is dramatically oversold. So the percentage of relative strength indices, so when we look at the RSI of a stock, most of those stocks now are trading at an RSI less than 25. Number two, negative investor sentiment. We can check that box as we discussed. The VIX above 30 for consecutive trading sessions. That was the case across the board last week. We started to come under that 30 level. We're going to go through how that trading has continued over the last week. CNBC, markets in turmoil, the flashing red lights. We've had those, and those have continued throughout the course of the last week. And then the big thing is, did we get a follow-through day after a big up day? So Friday, if you remember, the markets ended lower, and we had a big reversal higher. Did we get that follow-through day on Monday? We absolutely did. We got a big follow-through day on Monday on high volume. Yes, Wednesday and Thursdays has been a gut check, but the most important days were Friday and Monday over the last week, not Wednesday and Thursday. We need to pay attention to that because that's where the volume was and that's where the price action was. So in terms of the short-term trading action, we're going to look at ARK here. ARK has been, the ARK ETF has been at the center of the growth stock correction. We look at the degree of speculative stocks inside of that strategy and how they've been trading. It's a good barometer in terms of how even quality growth can trade and where we see things going forward. And what we saw was that preliminary low in and around the 24th of January. That was a day when the market opened deeply in the red. We had a lot of stocks trading down 7, 8, 9, 10%. and then ended the day green. That was that big reversal here. Then we rallied, and then we got another test, and it was at a higher low, or right around the lows actually. But the overall market was at a higher low. And then we got the big violent rally that we talked about Friday, Monday, and Tuesday. But what's happened recently is we've had a retest, right? To keep people honest. As this has rallied, all the people that were sitting with losses are starting to sell. So you get these retests. But guess what's happening? It's happening at a higher low again, right? So we're looking for those higher lows and higher highs. That's what we call a bottoming process. It can be painful because we think once we're up here, it's like, oh, hey, we're all clear. And then we get a 2-day gut check. And that's exactly what's happened. And we see the same thing playing out here in the volatility index. So real quick, when we say the VIX, it's the premium paid for put options. So put options bet that stock prices go down as protection against falling stock prices versus the price that we pay for call options. When the premium paid for put options versus call options expand, we see the VIX go up. Now, notice what happened. During that initial low, we got the VIX that almost touched 40 on the S&P 500, and then we came down as we rallied. Over the last couple of days, we've had that gut check retest as stock prices have come back down. But notice that the VIX really hasn't gone up with the rest of it, hasn't gone up as the market has sold off. In other words, I'm making a dramatically lower high. We want to see that divergence. That gives us confidence that we actually are in a bottoming process. We also have the NASDAQ VIX. So when we look at the NASDAQ VIX, very similar action. Big spike up above 40, comes back in, and then as the market retests and we see selling pressure as we did today and the day before, NASDAQ VIX really hasn't even crossed above 30. So again, a lower high while making higher highs on stock prices. That's another check in terms of the overall bottoming process. So what we wanted to do is kind of go through what did that bottoming process look in March of 2020, specifically with our strategy. So in March of 2018, this is when the overall strategy bottomed. And what we noticed is we had some big violent updates, not too dissimilar to what we saw in Friday, Monday, of Tuesday of the past week with our strategy and the market as a whole. But then, just as you think you've made, you've cleared that hurdle and we're off to the races, we had a 10.15% correction over the next few days until we were finally off to the races in and around that April 6th time period. So what is the message here is that, yes, the initial bottom can be put in and you get a sharp rally, but do expect days of volatility between now and when we get the final thrust higher and escape the overall market correction. And that's really what's happened the last couple of days. So when we look at what's happened here over the last week, and again, this is the opportunity strategy. We were up just under 4.5% on that Friday. This week started up 7% in terms of that daily return, then just under 2%. And then the next 2 days, we were down 4.8, and I think we were down 0.5 today. So we've had 2 days down right around 4.5% each day. But we had these 2 days that were gut checks, both Wednesday and today, Thursday, where we saw the retest after the initial low established in that rally. So the bottom line is this is very normal. It's very volatile, but it's also very normal during a bottoming process. And we know that the cash is piled up, and that provides the dry powder for stock prices to go up in the future. We see here money market assets and then retail money being raised has gone through the roof. So when we see frantic selling, so we see here, this is the retail cash levels, a dramatic increase during December and January. And we see the overall institutional money market assets, that's a fancy term for saying cash, is also near a record high. So when we see that frantic selling, that often leads to what we call oversold conditions. That cash at some point transitions to what we call FOMO, the fear of missing out during the recovery, and then that begins the fuel for stock prices to go higher. And we see that we're most oversold since March of 2020 on that 14-day RSI on the S&P 500. We had this bounce, gut check, and then we expect that resumption higher. To put that worst sentiment since 2013 into a picture, this is the overall investor sentiment. Down is bearish, up is very bullish. We're now at minus 29.8. That is the most bearish since 2013. And in fact, the fourth most bearish observation over the last decade. So what does that mean for future returns? So when we look at any other time where we've had this level of bearishness, what has been the average 3-month rate of return? We see here the average return over the next 3 months was 13.8%. That's just the market as a whole. We're not talking specifically growth stocks. We actually expect growth stocks, if this plays out, to be higher than that. And the win ratio was 100%. In other words, asset prices were higher 3 months forward when investor sentiment was this bearish 100% of the time since 2009. Real quick here on the economy, both manufacturing and service activity are starting to slow. Remember, that's part of our key objective for returning the growth stocks in 2022, is that we expect growth to slow. We expect the Federal Reserve not to tighten as much as people fear. And as a result, people and investors moving away from cyclical stocks, energy, materials such as copper, steel makers, automakers, et cetera, and back into those more secular growth plays. So ISM manufacturing continues to dip and slow. Same thing with the ISM services. We are seeing unit labor costs come down far under forecast. So all of the pieces are there for the economy to continue to slow. You'll notice we did have a negative ADP employment print this week. So again, this is not an economy that's making new highs. It's an economy that's starting to slow. And we should see that play out in terms of interest rates and overall asset allocation away from cyclical stocks and toward those long-term secular growth players, the ones that we've positioned clients into over the last month. Again, quick reminder, when everyone is fearful, when stocks are oversold, this is our high conviction buy zone. We only have a high conviction sell zone when the opposite plays out, when stocks are overbought and no one is fearful. So right now, stocks are dramatically oversold and everyone is fearful. We want to be buyers, not sellers. So what is the bottom line message for this week? Market bottoms are messy, they're scary, they're uncertain, and they're highly volatile, but are historically the best times to put money to work. We had that initial low 2 Mondays ago. We had the big low of our strategy Thursday of last week. We had a big 13.5% rally over the next 3 days. We've had a 10% gut check back. So net up 3.5% or so over the last week. That's the gut check. The next step is to clear the decks of the final sellers before we have that resumption higher. We had a lot of good earnings reports come out Thursday night. Let's see how the employment report comes out Friday and what that market action is on Friday. But I suspect over the next few days, we're going to see what we call stage 2 of the overall market recovery from that selling pressure in January. So bottom line, retail investors have raised cash at the fastest pace since the pandemic. That's a contrarian buy signal. Number 2, the S&P 500 RSI fell to 26. That's the lowest reading since March of 2020. Oversold buy signal. Lastly, retail sentiment, worst reading since 2013. Contrarian buy signal. All of these pictures, all of these elements come together to give us confidence that not only are we going to see a recovery, but a violent recovery. So if anyone has any questions or concerns, please feel free to reach out to our team. We know it's been a long month, but we're certainly here to help, and we are definitely excited about where markets are going to be heading here over the next couple of months. So thank you again, and have an absolutely fantastic day.